probably the more important market to watch in terms of the issue of the central banks. And remember, while the Fed is talking taper, and there's a lot of political pressure on them now to do something about inflation, the ECB is not. They're not softening at all, or hardening rather. They're still easy money, and the BOJ is thinking about going even more aggressive into the money printing again. Japan has not been doing very well, GDP-wise. So the issue for the Fed is it's an intellectual problem that it's a contradiction of the nature of what they do, because all their notions are wrong anyway. You don't, at the point of a gun, in effect, set the price of money. Money is a commodity. Like any asset, it has a value, different value for you or me or somebody else, a different situation. But the net result is free pricing of money, where it fluctuates based on overall demand and supply. They want to come in and say, no, we're telling you what the price of money is, no interest rates. And in so doing, they've created exceptionally low interest rates for a dozen years now. In fact, go to the St. Louis Fed website and look up Fed funds rate. And you'll see a chart of the Fed's funds rate, which is so ridiculous that you see over the past 20, 30 years, nice big rises and falls in the Fed funds rate. But then in 2009 and 10, it went down to zero, effectively, just laying there, a little hump up one in the middle of that and back down again. But when you look at that chart, you say, no wonder the stock market has gone berserk. Money's free. And the Fed's fund rate chart is it's the most ludicrous thing you've ever seen. And so the Fed has created a monster, a high-priced stock market that's valued based on the degradation of the money unit, not so much on the real world, okay? We think asset managers and investors are beginning to shift their money out of that category because they perceive risk or lack of reward going forward, and they're moving it into other areas, especially gold and silver, and commodity stocks in general, for example, which have done quite well. Fertilizer companies, you name it. If it's ag-related, it's gone up big, or copper-related and so forth. But there's one arena that the Fed will be very attentive to. It's both the muni bonds, local government, city government, state government bonds, which collapsed back in 2020, along with the stock market. Well, the Fed came in and bought those things in the open market. But then they also came in, started in May of last year, a couple months off the low in the markets, started buying high yield corporate debt, including the ETFs of high yield corporate debt, like HYG and JNK, junk ETF. These are corporate bonds that are high yield, meaning they're high risk corporate bonds. What's been going on technically since over the last couple of years is if you look at the charts of those two ETFs, they tend to move up and down with the stock market. They almost look like the S&P 500. The only difference was in the rally that we had in 2020 that put the S&P into new highs, they came back up and basically halted around their old highs and stalled. They stayed firm, but the Fed was the primary buyer of these, outright buyer of the ETF, something the Bank of Japan's done for years, It's a majority owner of a lot of the assets in Japan. But they quit buying in June. And I don't know whether they've started to divest themselves of this, but if you look at the charts of HYG and JNK, they've been coming down for the last few months and divorcing themselves from the S&P. Now, this is extremely critical because this market, if it fractures itself and starts down again, it's extremely important to the Fed and means that they can't tighten. Because if they tighten, in effect, they're going to kill this market again. They have to be accommodative. So watch that market if it starts to break. And we are literally about 1 point above on these ETFs, above levels that we determined at MSA, that they're turning down. And so I think if these two ETFs, junk and HYG, do break their structural supports on momentum, they're headed south again. And that's going to be panic time again inside the private door after inside the Fed meetings. They're going to be concerned again about these debt instruments because it has huge wave effects on things like employment or unemployment, businesses in general, and affects individuals, therefore. It's a wave effect. And so if those markets start to turn down, pay attention, because that's going to put a lot of pressure on the central bank here to not do what is being demanded that they do, namely taper. So it's going to be an interesting dilemma for them. The relationship between Bitcoin and gold, its spread relationship, its performance trend, in other words, not looking at its price chart, but it's difference between Bitcoin and gold that creates what's called a spread chart, the difference between them. And it goes up and down just like a price chart does. And over the last 5-6 years in Bitcoin, since 2016 or so, there have been some big up moves in Bitcoin in price and in net performance versus gold, beating gold and silver. But when we analyze the momentum of these charts, we come up with an observation that suggests don't be shocked that if by late this year, early next, that trend changes and it's measurable. You can't see it in the price chart of Bitcoin, but you could see it in the spread of Bitcoin versus gold and silver, that it wouldn't take much of a stall in Bitcoin and or a rise in silver and gold while Bitcoin stalls, let's say, to break that spread down, meaning turn cryptos into underperformers versus gold and silver again. So the 3,000-year-old metals become dominant again. It wouldn't surprise us. In fact, I technically tend to expect it. It hasn't shifted yet, but it's ripe to do so. So that would be an interesting event. That'll also narrow the focus of the alternatives somewhat, where money will say, hey, I'm not making as much money in Bitcoin as I used to. Now I think I'll go over to gold. It's looking pretty good. And so you could have a shift in that, which would also help boost gold and silver if that performance trend shifts. Again, I suggest somebody either look at momentum, get an S&P 500 chart, go back to 2009 and look at that chart with an NASDAQ 100 and tell me that's real. And then look at the Fed funds rate chart. You say, oh, now I understand. Okay, free money. Okay, and then look at the high yield corporate debt market as well and say, is that a normal event that we've seen over the last 5-10 years in that market? Resurrected from the dead and priced off the page and now acting like it want to go. So we're in the type of world where when these events start to come undone, and I don't mean gold coming undone on the upside, but these other markets, high-priced, artificially priced markets, come undone and back to the downside, could be dramatic in percent terms. And so many businesses and governments have been dependent on this ongoing process of cheap money and everything being accommodative, that if you shut that off and reveal that what has occurred over the last dozen years is perhaps way too artificial and it starts to come undone, it's going to come undone like a balloon, air coming out. And I don't think it'll be gradual. And the technicals tend to bear this out. They say, yep, those markets that have gone into upward curvature, when they turn down, they could go into a downward spiral rapidly.